Welcome back. The global cues this morning are a bit soft. Our market, of course, has been outperforming, but it's also shown some signs of fatigue. So let's see how the markets open. Well, in our special show, Editors Roundtable, we had a special guest, Ridham Desai, Head of India Equities Research and Strategies at Morgan Stanley. So we quizzed him about a lot of issues. We asked him about India's outperformance and does he expect this trend to continue?
Three very strong fundamental factors. The first is to do with the way the government focused on improving corporate profits. So it started in 2019 when they cut tax rates in September. COVID kind of delayed the effects of that, but we've seen corporate profits boom after that, and there have been several steps that have been taken to boost the share of profits in GDP. And this really comes from the understanding that when profit share in GDP goes up, companies invest, they create jobs, wages go up, and you get all-round prosperity. That cycle breaks when investments get excessive or unproductive, but we are far away from that. So that's the first thing. The second thing is the focus on FDI. So here are the numbers. In the previous cycle, that is the 03-08 cycle, there was about $50 billion that foreign portfolio investors put into the equity markets, and FDI was $40 billion. We were heavily dependent on foreign equity flows. In the last 8 years, FDI has been $550 billion and foreign portfolio equity flows is $45 billion. Okay? So what has that done? That has broken down India's correlations with oil. So notwithstanding the war and the spike in oil prices, India did not behave badly because unlike the past, India didn't depend on portfolio flows which are very sensitive to oil dynamics, unlike FDI. US growth cycles. So even though the US is facing a possible recession, India is not behaving badly. If you look at the last 30 years, all the US recessions have brought deep bear markets into India. This one, I think India will skirt that. Okay. And the third thing it has done is it has actually also, I think, affected the way India is responding to various other global developments. So it's kind of made India more idiosyncratic. I dare say India cannot decouple from the world because we are very big now. We are the 5th or 6th largest market in the world, 5th or 6th largest economy in the world. So we're like a large cap stock in the nifty. We're not a small cap stock that can do its own jig. So we will be sensitive, but the sensitivities have reduced considerably. So that's the second thing. And the third thing is the the work that has been done on domestic flows. Let's not forget in 2015, for the first time, the government allowed retirement funds to invest in equities. They come every month to buy. Everybody focuses on SIP, but last month ETF flows were 15,000 crores. They're bigger than SIPs. And retirement funds only get net flows, inflows. So they keep buying every month. And this is very similar to the story that happened in the US between 1980 and 2000. Because in 1980, the then administration in the US allowed 401k plans to buy equities for the first time. And you got a secular run on domestic flows in the US. And I think we're in that secular run in India. We're in the 5th or 6th year. We have a long way to go before this thing ends.
Okay. Ridham, every time I see you, you keep getting fitter and fitter. So the market's health, Ridham, considering the points that you just raised, are we now in a market which will just not fall? Peak to trough, we had 18% fall, and then the market moved on. In the last bull market, we had so many instances of 30 or 40% fall. I asked you this question because when FIs are selling, retail really picks up the piece, and after a while, we see FIs buying like gay abandon, like we've seen over the last couple of months. So are we in a market which will just not fall? The kind of fall that we used to have?
No, that's not possible, Anuj. Equity markets are going to fall whenever we least expect them to. And let's keep a note here. We've done nothing in the last 1 year if Nifty is your benchmark. In fact, we're down actually in a year, right? So if you were just buying the index, you've actually made no money. It feels like we're doing very well because a lot of stocks are actually doing a lot. But on average, neither the small cap index nor the Nifty has gone anywhere in a year. So the global bear market has weighed on us, despite the fact that earnings are very strong. We have the strongest earnings in the world, but the markets are actually, they're outperforming, but not actually going up. And they may continue to outperform, but the absolute call still hinges on what the world's largest market does, which is, the SPX. So if the SPX, goes down to what my US strategist thinks is a bear case of 3100, the Nifty is going to struggle to go up. It will also fall with it, but it will fall less and will outperform as we have done this year. Even that outperformance, I think, is now at a extreme point, which may lead to a little bit of a correction even in relative sense. So markets have to go up and down all the time. They can never be. It's not a fixed deposit. You arrive every morning and you put a few basis points on it.
Ridham, you spoke about earnings very strong. But what about valuations? I heard you, in the Chennai conference as well, that don't look at 1 year, 2 year down the line, but look at 4 year point of view, and then India valuations will look cheap. For the larger audience, if you can just explain that thesis on why you feel valuations are not very expensive for India at 20 times forward earnings.
Yeah, so as I was mentioning to Sonia, we are in this big profit cycle, and right now corporate profit share in GDP is 4%. It was at 2% in 2019. It peaked at about 7% in the previous cycle, around 09-010. I think it will probably cross that peak.
Okay.
So probably it's going to go to 8. Even if nominal GDP growth is say 10%, and this journey takes place in the next 4 or 5 years, earnings will compound at over 20-25, around 20-25%.
Correct.
So now if you look forward, because equity markets are forward-looking things, right? And the market gets an idea. It is not stupid, okay? So it knows that there is a fair bit of earnings coming through. So a little bit of it is in the price. But if you compound at that rate, then you are trading pretty inexpensive. You look back when you reach 24, 25, and you'll think, oh, I didn't buy stocks in 22 thinking they were expensive, but they were not. This is very similar to the 04-07 cycle. Every time you look back, stocks looked expensive on trailing earnings, but not when you had moved forward in time. So that is the base case scenario.
Is that something which even your FI clients are now looking forward to, and that's the reason why the FI money is back into the Indian markets?
I think foreign... Again, I'm not saying this on behalf of any single individual investor, but on the aggregate, I think they missed the big picture in India. Okay, there was a fair bit of skepticism about whether India had enough policy traction. I think a few mistakes were made, and they overly focused on those mistakes, not understanding that they were mistakes in the context of some very big policy shifts that were happening. Like, for example, GST. So I used to keep arguing with investors on GST that if you think GST is slightly compromised, just imagine taking the 50 states of United States of America and asking them to give up the power to tax forever. Do you think you'll ever achieve that in your lifetime? So if you want to make such seminal policy shifts, you have to compromise a little bit and then work through those over time and see how it has succeeded now. So I think they missed the big picture, and now they're realizing that India is like the best house in a pretty weak neighborhood.
Ridham, that point about FII and FDI, that 8-year period that you spoke about, that's very interesting. Could you tell us this 450 or 500 billion dollars in FDI flows? You said that insulates us from a lot of global volatility. I mean, we don't produce the oil that we use. At least we produce about 20% of it. We don't print dollars, right? Could you explain why this 450 or 500 billion dollars, which has come in as FDI, how does that insulate us and put us in a better place? I mean, if you can.
So see, Prashant, FPI flows, which is capital market flows, are a lot more sensitive for short-term movements. So oil goes up $20, they will sell. I'll give you an example. 2008. When the global financial crisis was happening, or I would say Western world financial crisis, India was largely unscathed. Our banking system was fine. Yet that year, India was the second worst performing market in the world in US dollar terms. Why? Because middle of that year, oil went to near $150, and as soon as oil spiked, foreign investors sold. FPI selling in that year was $20 billion. We couldn't absorb that, and the stock markets had to correct. Okay. So that is the problem with FPI in equity, which is that if you're overly dependent on that source as your funding source for your external balances, It's going to be very sensitive to oil, it's going to be sensitive to global events, it's going to be sensitive to US rate cycles. Okay, we're no longer dependent on them. So therefore, look at the change on the macro. The RBI can lag the Fed. That hasn't happened since we opened our doors to foreigners in 1992. We've always had to be a step ahead of the Fed. When we dared lag the Fed like we did in 2013, we got smacked. Okay. Now we can comfortably lag the Fed. We don't have to do what the Fed is doing. So, the Fed may raise by 75 bips, RBI is going to do 50, and it's already done less than what the Fed has done in the last, 3 policy meetings. So that strength has come from the fact that our macro balance sheet no longer depends on volatile capital market flows.
Okay. Is that one reason, Ridham, that we have seen this rally essentially been about domestic stocks? The bank nifty is at new all-time high. Auto index is there. FMCG index is there. IT index is in a bear market still. Do you think that this sort of trend will continue then?
So, Anuj, IT depends a lot on global revenues, particularly the US. And if the US is going to go into a recession, then some of those revenues will fade away, and therefore there will be some near-term earnings pressure. So some of that is now, I think, reflected. I would actually be a bit of a contrarian here and start nibbling at the IT stocks, because again the market is looking forward. So unless this US recession is deep and broad and lasts for a few quarters, I think IT may be now finding a bottom. But if our base case is that this is going to be a short recession, 1 or 2 quarters, not a 4-5 quarter recession. So based on that. But yeah, you're absolutely right. Domestic still looks more exciting. Financials is clearly the place to be. Unambiguously, we are about to enter a loan boom, which will match the pace and scale of the 04-07 era. In the last 4 or 5 years, corporate balance sheets have delevered. Corporate debt to GDP is 46%. I think no large economy in the world has such low levels of corporate debt as India has. And growth is strong. Capacity utilization is rising. So we are set up for a capex boom. Therefore, we are set up for a loan boom. And I think banks' balance sheets look really good. Valuations are inexpensive. So I think you're going to get a ferocious bull market in financials.
Someone's in a really good mood today, I must say. Very, I think this is the most optimistic I've heard you in a while.
No, I'm always equity markets are only for optimists. If you're a pessimist, go and do something else.
No, but you have
I'll tell you why.
I've been cautious in the past.
No, I'll be cautious even now, okay, Sonia? So I'll tell you all the pitfalls also of this, and nobody should assume that markets are going to go. Anuj asked a very good question.
I don't want to hear the pitfalls because
no, I have to say that.
No, you spoke about how you're nibbling into IT. So tell us where else you're nibbling. Pitfalls everyone knows.
So see, Sonia, the stock markets don't do a straight line. Okay, so nobody should assume here that tomorrow morning they're going to go up 1% and then 1%, and if they do that, then they're going to fall precipitously. So the question that Anuj asked is very relevant. But there are a few risks out there. We should not, ignore them. There is a risk that the war in Ukraine continues. It's leading to very high gas prices. Ammonia plants are shutting down. Fertilizer prices are rich. We have doubled our fertilizer subsidy. If fertilizer prices don't come down, it is going to put a burden on India. We have very little appetite to pass them on to farmers. Food is 50% of our CPI basket, so be very wary of that. Hopefully the war ends soon and the effects of the war fade away into 2023. If they don't, then we'll have a challenge. Then we have a US recession. 20% of India's GDP comes from abroad. Okay, so if there is a Western world recession, then we will see a slowdown in export growth, and you can do the math. If exports go from +15 to -15, that's a huge drag on our economy. It will derail job growth. It will create a problem on capital spending. Profits will go down. So it's not all hunky dory.
Optimistic Ridham is now cautiously optimistic.
No. It's not all hunky dory out there. It's essentially a question of time frame.
Yes.
So are you in this for 3 months or are you in this for 5 years? If you're in for 3 months, good luck. Okay, because luck is going to decide what you will do. If you're in for this for 5-7 years, there's a lot of money to be made.
Okay.
I keep telling my colleagues, a lot of us will be retired if we have money in the stock markets, because this will be a massive bull market. There'll be one more caveat that I'll put here, because since we're talking a 5-year time frame, we still have to negotiate 2024 elections.
Okay.
And we're a democracy, nothing can be said until it's done. I think it'll be a very important moment.
That's actually the most bullish I've heard Ridham Desai in a long time. So on that optimistic note, let's take a quick break. On the other side of the break, we will get